Hello, hello, hi everyone, evening. All right, welcome to day 22 of Project Options Cashflow. All right, evening everyone. Hi Uncle Fu, evening. Hi Anthony, hi May. Okay, now, if you've joined us this evening, drop a note, drop a comment, say hi. All right, it's Monday night, the start of the week for week 3 over here as we go into Project Options Cashflow. All right, hi Kane. Okay, we'll just wait for a couple more people to stream in and roll in before we start the session proper for today. Now, so today's topic is going to start with our new segment called Options Language. So today we're going to discuss some language that is commonly used when trading options, and it is good to know about when you're also trading options. Yeah. All right. Hi Zen. All right. Yes. Thank you very much. I probably need some coffee today. All right. Hi Josephine. Hi James. Okay, now, if you're joining us in the session early, could you do us the same old drill as well? Click on the share button, share out the videos as we try to reach out to as many people as we can during this period of Project Options Cashflow. So we'll be able to help as many people as we can understand about options and clear up their misunderstanding as well. Okay, now the next part is, of course, to bring more new people in so we get more interaction as well over the session as we run it. Yeah? Okay. All right, so let's get this session started and going while we wait for more people to join us. Okay, thank you very much for joining me on week 3 again. I've noticed, there are a core set of you who have been joining me every single day since we began this journey in the month of June. Yeah, okay, so today is week 3 over here, and let's get started. All right, hi Side, hi FT. All right, FT, long time no see, FT. Okay, welcome to Impossible Investors Project Options Cashflow, which is a challenge we're challenging ourselves to educate investors more about options every single day throughout the month of June. Okay, now, so before I start the session proper, just some standard disclaimers. Anything that's being shared possess a risk of loss because we're on the topic of investing and trading. So be aware, weigh your own risks before taking on anything that we're discussing over the session. All right, hi Wyman, hi Benjamin. All right, okay, hi Jacqueline, hi Jesslyn. Okay, give me a minute. Right, here we go. All right, now, so as I was saying earlier, just a disclaimer, which is standard for every session. It's just a matter of discussion over here, all right? It's for you to learn more about options trading and clarification of any doubts. So do make your own risk assessment before following or taking on any trades if we are going to discuss any this evening. Okay, now, so today starts day 22, which is the 3rd week, and today we're going to the options language. So today we're going to try to clear up this concept and the difference between time value versus claim value. All right, now, so with options over here, many people get the confusion that, Terrence, when I trade options, do I make money when the stock moves? All right, so do I make the money when the stock moves? Or, do I make from the premiums itself? All right, now you need to think of it as a body that's coupled together, all right, but you only profit from the asset that you're actually trading. Okay, now the assets are joined, kind of joined at the hips to a certain extent, okay, but you're still really trading only one particular asset, so your profits still come from that particular derivative that you're trading. Okay, now what do I mean? I'll elaborate it further. Okay, now what's the difference? Yeah, how to know which are you getting or which are you paying for, right? Which is actually more important, right? What's the difference if you're a buyer and what's the difference if you're a seller of options? Okay, and then how do you use this to choose the correct strike versus expiry? Okay, and then we'll start to end off the session with some trade applications and practical sessions over here. Okay, now, so let's talk about option premiums. Let me take away give me a minute. All right, here we go. Okay, now, so option premiums. So option premium is pretty much made up of this, all right, in definition terms. Of course, when you trade options, if you're really academic, the calculation of option premiums are pretty much derived upon, all right, by this formula that we call the Black-Scholes model, right? But the Black-Scholes model doesn't accurately price the options because there are certain things that, changes every single minute and second. So there's the element of supply and demand from the market as well. So it's not a perfect mathematical calculation as well. Okay, now, so in basic terms, all right, or what we call most simplified format, option premium equals to what we call intrinsic value versus time value, right? Now, intrinsic value versus time value. Now, so something that I always tell my students, all right, that may help them, understand the concept of intrinsic value a little bit simpler, right? It's to think of intrinsic value, which may not mean anything to most of you, right, as something of the sorts of claim value over here. All right, now, what do I mean by claim value? When you trade options, it always has something to do with the underlying, which is the stock. Okay, now, specific action to the stock, which means, right, you'll either end up, right, with an action which involves buying or selling the stock. Okay, now, so, right, it's a matter of what's the stock price currently versus what's the strike price of the options that you have selected. Right now, when you offset these two numbers and amounts, right, is there a claim that is present if you actually take action immediately, right? This is what we mean by claim value. Okay, all right, now, then there's also another element called time value, because options, just like insurance that I mentioned earlier, right, it's an element of time. All right, it doesn't expire today, it doesn't expire tomorrow, it may expire like the end of the week or next week or a couple of weeks later. All right, so these are all what we call time value over here. Right, time for something to happen. Time for something to happen, all right, in which, all right, the option buyer or the customer will have to pay for this amount of time. Now, so let's talk about this now. So intrinsic value is pretty much, like I said, claims. Now, so the bigger the claim, the bigger the premium. Now, think of it this way. If we are talking about just a simple $21 call option today. Now, so people who buy a $21 call option wants the stock to go up. Okay, so today, if we have the stock price going up and all the way to 25 right now, okay, the claim value that we're looking at right now is the possibility, right? The possibility or the right, okay, to buy the stock. Okay, that's what a call option gives you if you buy it, right? It gives you a right to buy the stock. At what price? At this price, which is 21, right? But if you get to buy the stock at 21, you could also immediately go to the stock market and then sell it off and reap your profits. What's the stock market price? 25, right? Now, so that means that we're looking at a claim value of $4 from the option itself. Now, so this is what we really mean over here when we do options trading and we talk about the bigger the claim value, right, the bigger the premiums. So if you're choosing what we call a 20 call, all right, like a 20 call instead, okay, it packs inside it with the stock at 25, all right, an intrinsic value or claim value of 5. So any market value to this particular 20 call option is going to start from $5 and upwards. So $5 plus time value, right? That's how you think of it over here. Okay, now, next, right, when we talk about the element of time, right, it's actually a very simple measure. The lesser the time there is, the less expensive you're going to pay for it. The longer the time, the more expensive it's going to cost. So the total price of the option premium, right, it's also relevant to what's the expiry timeline, because options expire from the nearest Friday all the way out to 2 years from now. Okay, now, so it's obviously just sensible for the same strike option, all right, to cost a lot more with a 2-year expiry versus the one that's probably going to expire this Friday, right? Okay, right, now remember, anytime I go through this different topics and ideas over here, if you have questions and you have doubts, and you want me to clear them, just leave them in the comments, okay? Because today we're going to options language, so some of you who may be new with us, right, may get lost with some of these terms, or may not understand the first particular way in which I use to explain the concept of it. Okay, I always tell my students I have many different ways to explain it. All right, the first one I use may not be the best, so if it doesn't help you, all right, let me know. So I'll try a second. If it doesn't work, I'll try a third. All right, I have many different ways. Okay. All right, now, so let's go into specifically different type of options now. So when we talk about call options over here, what's intrinsic value? Okay, intrinsic value is simply taking the current stock price, okay, minus off the call strike price. That's going to give you a claim value or an intrinsic value if there is any, right? Because if you realize what we mentioned just now, right, the call strike price is 21, right, and then the stock price was 25. So if we go into the formula right now, you would see this. The stock price is at 25 minus call strike price, which is 21, right? That's going to give me 4, right? So $4 is going to be an intrinsic value. Okay, now, so any positive amount would represent an immediate claim value if you actually decide to exercise the options today. Okay, now that's dependent on if you're going to exercise the option today. Okay, all right. Give me a minute. The screen went away. Okay, great. Now, how about put options then? Okay, so for put options over here, this is how you calculate intrinsic value. So intrinsic value is simply put strike price minus the stock price. So we flip it around. All right. So you realize it's just a matter of flipping around the positions. So for put options, the put strike goes in front minus the stock price. So any positive amount, all right, it's going to represent a claim value if the option is exercised for the stock today. Now, so let's do a quick test of it. If we have a stock right now, all right, and the stock is sitting at 18, okay, 18. Now, can anybody leave in the comments over here, right? Can anybody leave in the comments over here if I have what I call a $25 put option? Okay, if I have what I call a $25 put option, right? Can all of you leave in a comment and tell me, all right, what's the intrinsic value of this particular put option? Right? What's the intrinsic value of a $25 put option, okay, if the stock price currently is trading at $18? Right? Leave it in the comments, okay? Leave it in the comments. Let me know. All right, just a simple quick test, right, to make sure all of you understand the formula that you're seeing in front of you. All right, great, Kane. Very quick. How about the others? All right, anyone else joining us over here? FT, yes, 7. All right, yes, SD. All right, long time no see as well. Sai. All right, Anthony, yes. All right, so everyone's getting it right over here. Great, thank you very much for participating. Okay, so let me move on. So how do you understand time value? Okay, now, so we're done with intrinsic value, we're done with claim value, so let's understand time value. Okay, now, as I see right now, more of you have joined us. So if you have not done so, do assist us. Click on the share buttons for the video. All right, so we are able to share it out and reach more people over the course of the month of June and Project Options Cashflow. Okay, all right, now, so how do you understand the matter of time value? Now, take a look at this. Which call strike would most traders buy if you expect WFC to go up? Okay, all right, now, so which call option would people buy if you expect WFC to go up? Okay, all right, now, or you could think of it this way: which call strike represents the best buy for a shrewd option investor? Okay, the best buy for a shrewd option investor. Okay, now, so this is all assuming, all right, assuming that you are very sure, right? That means you're adamant and you're very sure, be it with your technical analysis or everything that you're doing right now, okay, you are like what we call a 90% sure that WFC prices are going to go upwards. Okay, now, so if this is the case, then the question is, which type of call option should you be buying? Okay, which type of call option should you be buying? All right, anyone? All right, anyone? All right, now, so this is basically a question I'm throwing out again. So again, if you are looking for a call option to buy because you think the stock is going up, all right, and you're pretty sure about it, so the question now is, which option call strike will be the best buy if you're really, really screwed in your selection? All right, so James says 25. All right, so let's look at the next answer that's going to come up, all right, after James. All right, what about the others? Okay, what about the others? James says 25. All right, FT says 25. All right, Zen says 35. All right, Zen says 35. Okay, all right, Kane says 1250. All right, okay. Now, so we have FT over here, which says 25. Right, and then we have Zen, which says 35. Okay, and then we have Kane, which says 1250. Okay, it's all over the place. All right, so Javon with 2750. Right, and then Josephine with 30 and Wing Kai with 1250. Okay, now, so we're going to discuss this right now. Okay, now, everything, all right, everything that you buy over here, right, is right. Okay, is right. It's going to be right as long as the stock goes up, right? But each one of them presents a different challenge. Okay, now, what do I mean when I say each one of them presents a different challenge? Now, if you look at it, what we've just understand was the concept of what we call intrinsic value. Okay, intrinsic value. Now, an intrinsic value for call option was very simple. You just take the current stock price, okay, just take the current stock price minus, okay, the call strike price. Okay, current stock price minus the call strike price. And you would realize if you do that, okay, all these strikes over here, does not possess any intrinsic value, right? That means whatever you are paying for, right? Whatever you're paying for over here, all right? It's all a matter of what we call time value, okay? Now, and time value, you realize right now, time value is what you're paying for something that you do not get, okay? You're basically paying for the amount of time that you're getting, right? But there's no value tag to it because for any value to be created, right, the stock has to go up. Right? That means your indication, your thoughts has to be right. Okay, where else, if we take the current stock price and we minus these sets, okay, these sets of call strike prices, okay, they are in yellow over here on my screen, they are highlighted in yellow on my screen, each one of them actually represents a certain amount of intrinsic value, right? Let's take a look at it. 2444 minus 2250, all right, we have an intrinsic value of 190-ish, all right, okay, I don't know the exact number, I can't get it off my head, but that's somewhere around 190, okay, but if we choose the 20 strike, that means we're looking at a 444, right, intrinsic value. If we look at the 1750, we're looking at 694. All right, 694. If you look at the 15, then you're looking at 11. Is it 11? No. 15, 944. All right, okay, 944. Okay, and then of course the last one, 1250, then you're looking at something along the lines of 1194, all right, somewhere along those lines. Now, so you realize a big difference over here, all right? What's the big difference? All right, for a call option that is at 25 strike, right, you're paying hefty amounts. In fact, the most hefty amount, right, when it comes to time value. Okay, so that's the most amount of value you need to claw back, all right, in terms of the upwards movement from the stock, okay, in terms of time value. Now, whereas if you choose the 2250 over here, right, you'll realize that, yes, the option costs more, right, it probably costs somewhere along the lines of 360, right, but out of the 360, 194 is it's calculated out of intrinsic value, right? So if we take 360 minus 1.94, right, effectively you're only paying 166 for time value. Okay, 166 for time value. So you realize that the stock probably needs to go up by less, okay, for you to become profitable. Right, now next one, 20. right? It has 444 over here, right? And the option costs around 540. Okay, so that means we are paying now $1 for the element of time value, right now. And then over here, right, we are paying now about 50 cents for time value. Okay, and then now over here, we are paying around about there as well, I think, right? 975. 975 minus 944, right? 30 cents in time value. All right, and then 1250 strike, which is almost $12 in value, you're paying about 10 cents in time value. All right, now, so this is getting a little bit technical over here, but right, when you're buying something, all right, that means you're buying something over here today, right, and you're very sure that it's a quality item, all right. The key over here is you're very sure that it's going to be a quality item, all right. What you want to do is you want to pay for exactly what you get, right. So you want to try to minimize the amount of time value that you're actually paying over here, right. So, all right, I would say if you're very sure that the stock is going to go up, all right, these three over here, right at the bottom, all right, will represent the best value to be paying, all right, because you're forking out very little, all right, for the time, all right, and this time is worth 90 days, all right. Can you imagine that, all right, for the next 90 days, you are only paying a 50-cent premium, all right, that means you're paying a 50-cent premium from the value that you're immediately getting in this particular call option right now today. Okay, now, so if these three are the best, then how do you choose from here? Okay, how do you choose from here? Now, so once you have achieved what we call the best suitable range over here in terms of value that you're paying, right, what you should do is you should then start to adhere to what's enough is enough. Okay, now, because obviously you see, the first one over here, which is the 1750 call, you're paying something along the lines of $7.50. The next set goes up to $9, and then of course $12. Right now, you also want to make sure you don't overpay for intrinsic value, right? Because enough is enough. You don't need to overpay for it. So if it was me over here, I'll probably end up choosing somewhere along the lines of $17.50, right? So if I'm really wanting to go long on the stock, okay, so this is also something along the lines of the strategy we discussed, synthetic stock position, right? So if you want to buy a stock, okay, this is something that you will do as well. The reason why you buy a stock is because you think it's going to go up, so you want to profit as much as possible and as soon as possible as well. Now, so paying 50 cents for time value, right, pretty much gives you the best option over here. Yeah, okay, so the right strike over here is the 1750 call, right? Now, 1750 call, okay, right now. So because you're paying 50 cents for time value, it simply means this: when the stock goes up by another 50 cents, you have achieved break even. Anything higher than that will start bringing you profitability. Okay? All right. Now, good attempt there, everyone. All right, now, so the stock is at 24.44. Oops, wrong side. 24.44. You buying the 1750 call, right, would make the break even over here at 25. Right, at 25. Now, so anything above 25 is pretty much profits, and your profit is actually unlimited. Right, so unlimited profit on the upside if you buy a call option. Okay, all right, now I hope that is clear for everyone. Now, so how do you use this strategy? Okay, now you try to mimic as close to the stock as possible over here. Right, that means you want the quickest to profit scenario once the stock goes up. Okay, which is to minimize the value that you're paying for time. Okay, control the max loss of the scenario on the investment. Okay, you ensure maximum impact from the stock movement, right? And you ensure reduced impact from the stock movement downside. Okay, all right, now, so buy the right call, all right, and it's gonna bring you the lifetime of fortune over here. Buy the wrong ones, and you're gonna be wrong a lot more often. So of course, when you trade options, if you're wrong, that means you're going to be bringing yourself losses, unless you are sellers like us. Okay, all right, now, so that's one of the reasons why we love being an option seller, because option sellers allow you the luxury to be wrong on your directional bias on the stock, but you can still end up being profitable. Okay, but today we're talking about buying the call option. So if you're wrong, right? It's going to end you in a lifetime of misery because you're going to just keep losing money in the stock market. Okay. All right. Okay, now, so this is pretty much the technical side of things that I want to discuss over here, right? Which, is the element of time value versus claim value, right? Nothing much else to elaborate further on it. So what I'm going to do right now for today's session is going to take questions or, application questions to any of you who may have, towards this two little, how should I say, technical terms when it comes to trading options. Okay, the effect of claim value and the effect of time value. Okay, if you have any questions, time to raise them up in the comment section. Okay, while I prepare the brokers platform and bring you over to the brokers platform. Okay, anyone with questions, all right, feel free to type them in the comments over here, right, with regards to intrinsic value or claim value when it comes to choosing options. Okay. All right, give me a minute, everyone. My brokerage platform shut down earlier, so I've got to spend some time restarting it right now. Okay, but in the meantime, if you have any questions and doubts, do make sure you post them in the comment section, so we'll be able to pick them up and start addressing them for you, which is our main aim and goal over the course of this 30 days as well, to get you to know and understand as much about options and the terms with regards to options trading as possible. All right, great. Great. Okay, nobody has questions. Okay, so hang on for a minute. Let me get started the brokers platform and then show you a couple of examples in terms of choices for call options and choices for put options. Okay, and what kind of difference it brings about. Okay, now since we are waiting for the platform to get started, I might as well take this opportunity to elaborate a little bit further on this trades part. Okay, let me try to erase everything over here. All right, give me a minute. Okay, how does this claim value and intrinsic value, right, ultimately affect your opportunity and chances to profit from the trade? Okay, so let me use this right now to elaborate a little bit further. Right, so everything about options, especially as a buyer, the first thing you got to achieve is what we call break even before profitability. Now, so you realize that if you buy the 22.50 call option, okay, and you're gonna pay somewhere along the lines of $3.60 for it. Okay, that means from this price right now, from the strike price, the stock has to go up another $3.60, right, which is what you're paying up front right now, okay, in order for you to be profitable. Okay, so your break-even price for this option is going to be somewhere along the lines of 20, 25, 26.10. Okay, so the break-even for this call option is 26.10. Okay, for the 20 call option, you're paying 5.40. Okay, it's going to be 25.40. Okay, for 17.50, you're paying 7.50, so that's going to be 25. Okay, and then for 15, you're paying 9.75. So that's going to be 24.75. Okay, and then finally 12.50, paying about 12.10. That will be 24.10. Okay, all right, now, so today the stock is over here, so it needs to go up for you to be right on the call options. Okay, right to what extent? Right meaning how much must it go up by? So you realize the first one to profit is going to be this call option, second, third, fourth, fifth, and of course we continue to go down the line because 25 plus, let's say 220 means 27.20. Okay, and then 27.50 paying 125 means 28.65, right? And then 30 plus 70 cents is going to be 30.70, right? And then 32.50 plus 40 cents, right? It's going to be 32.90, and so on and so forth. So you realize when the options start to get to a point where it's without any claim value, right? The jump that is required for the stock to go up by, right, significantly rises. Okay, so that means if it's harder to achieve break-even status, it's going to be harder for you to even get profitability, because that happens after break-even. Okay, all right, now, so I hope that clears up the doubt for some of you. Okay, how do we decide if we should go okay, all right, now that means, okay, Kane is asking in relevance to selling options, okay, all right, now, so not so much on the buying side, but in terms of selling side over here. So how do you decide if you want to sell on a short-term basis over here, which means a week to a month, or how do you decide if you want to sell long-term over here when it comes to options? Okay, no problem. We'll discuss that when I go over to the brokers platform. Okay, anyone else with any other questions? Let me move over to the brokers platform. Okay, here we go. Markets are up slightly today, all right? Can you guys see the weird thing about the market over here? All right, now the weird thing about the market is the S&P 500 is up, right? But the rest of my screen over here is pretty much in red. All right, now this just shows you that market is probably not going to sustain this up move over here that we're seeing right now. Okay, because it's everything that's everything should be correlated. All right, if we have a market that is going up significantly. All right, now how can you get this over here? Right, on TD Ameritrade, they have this very, very interesting feature. If I'm not wrong, let me see, where do I get it? You get it under Market Watch, going to Visualize tab. All right, now under Visualize tab, this is probably what you see on CNBC and Bloomberg, what they call the heat map. Right, but usually I look at what we call the Index Watch. All right, now, so when I go to the Index Watch over here, I just want to bring up, for example, say the S&P 500 index. QRS, yes, here I go. All right, and then it's going to bring up the S&P 500 on my other screen. Oops, sorry. QRS, S&P 500. Okay, done. Now, so as you can see over here, the weird thing, you saw the S&P is up, all right, or at least the futures is up. Let's see the S&P itself. Oh, the S&P is down, all right, but the futures is up. That's weird. All right, let's be. Oh, okay, the futures are playing catching up because it was triple witching last week. All right, so you can see right now the futures are actually at a discount, right, which means the traders are expecting S&P to go downwards. Yeah, okay, all right. So S&P is down today, so we have almost 400 of the 500 stocks inside. Okay, the S&P 500 that is on the downside over here today. Okay, so we may start seeing some selling coming into the market, right? And the biggest drop right now is AAL, right? American Airlines. Okay, it is down currently by almost to the tune of 6%. All right. Now, next one is ALB. All right, ALB is down to the tune of about 4% over here. All right. Now, of course, you have the next tier, which is CCL. So it seems like today is going to be sell travel stocks. Right, today the market is selling off travel stocks over here, it seems. Okay, DISC Entertainment, all right, Discovery, all right. DAL, Delta Airlines, is another big dropper over here. Oh, we have a big up over here, GPS. What's GPS? Let's take a look. Oops, sorry. Gap. Interesting enough, Gap is up. All right, Gap is up. All right, by the tune of 6%. All right, it's a really cheap stock, but Gap is up. All right, probably some good news over there. Okay, now, so there's Market Watch visualizing over here. Okay, all right, now, so let's get to my topic of discussion. So what I really wanted to show you, let's take Gap anyway. Let's take Gap. So since Gap had a move today, and let's say you assume that it's going to recover for the entire retail sector. That means the retail sector is going to continue to recover. All right, so let's see. What you can be doing over here is you may be potentially looking for an upside. So you will look for a call option to be buying. All right, so let's say you look for a 60 days expiry. Okay, so all the way to August, 60 days expiry option. Okay, so these are your choices over here. All right, so again, once again, let me change the font size to try and make it bigger. Oh, it's already large. Looks relatively small today. Okay, now, so if you buy the $12 call option, all right, you have to pay somewhere along the lines of $1 and maybe 35 cents or $1.40. So your break even is going to be $13.40. Can you see what a challenge that is? All right, $13.40. All right, so by August, the stock has to go up above $13.40. All right, for you to even break even. All right, that's only break even, and that's like another $2 away from right now. All right, so can you see, like, just from a perspective of common sense logic or mathematical standpoint, how difficult that is? Because a $2 move on an $11 stock, right? That's, you know, more than close to almost 20% that you're looking at over here. That's the challenge that you're giving to the stock. Okay, where else, if you're just sure that it's going to go up, right, but you really don't have an idea of how much potential it has, okay, what you might be better doing over here, right, is doing this, what we call buying an intrinsic value call option. Right, so you may be looking at something along the lines of maybe $8, for example. All right, so $8, you're paying about $3, say 70 cents for the call option. All right, so 8 plus 370 will put the break-even price at 1170. Right, 1170. Right now, so that means all it needs is another day like what it did today. Right, and you have probably achieved break-even. Okay, now, so this is the element of time value over here, right? So the smaller amount of time value you pay, all right, the faster you're going to achieve break-even status when it comes to the call option side. Okay, all right, now, so I hope that clears out your doubt in practicality terms, looking at the markets and possible stocks. Okay, all right, so let's address Kane's question. Okay, now, so Kane's question is in relevance to selling options. Okay, now, so if any of you are joining us today and you're not familiar with selling options, do go over to our website. Okay, do go over to our website. Okay, and which is www.impulsibleinvestors.com. Right, look for the Project Options Cashflow logo. Right, click on it, opt yourself into the email system, and we will start sending you from day one all over again. So you'll cover a lot of topics from buying options to selling options, all right? And that's where you're going to build up your arsenal of understanding when it comes to options trading. Okay, now, so short term over here. So Kane's question: how do you decide if you want to sell short term or long term over here? One way to decide is, first you got to start with your objective of the stock. Okay, your objective of the stock, all right? And second, right, where do you think is the stock price currently? Okay, where do you think is the stock price currently? Okay, now, so in relevance over here, let's take a look. If you're looking at a stock, for example, let's say today, you're looking at a stock like BRKB, right, Berkshire Hathaway, right now. So what you're seeing right now is Berkshire Hathaway as a stock itself, right, is currently trading, right, but it isn't too high or too far away. Right, it isn't too high or too far away from what we call the lows that it made recently. So the lows are around 160. All right, it's gone up, of course, a little bit to 190 right now. Okay, but if you are, this is a stock that you're trying to acquire, right? Actually acquire in your portfolio. Okay, then you'll probably be wanting to look at selling longer term expiry on this particular stock. Okay, longer term expiry on this particular stock. Okay, because selling longer term options over here will generate larger amount of payments for you. But do understand this as well, right? When you take a larger payment up front, right, the larger payment usually has a discount when it comes to time value. Okay, all right. Now, why do I say this? Because that's assuming, right? That's assuming that, you know, on the short-term basis, you are going to repeat the trade, or you're going to be able to repeat the trade over and over again, right? And over multiple times. Okay, now I may not explain this, you know, in a very, how do you say, sentence-like format. So let me show you in numbers format. Okay, what do I mean? Okay, now let's bring up BRKB. The numbers will usually make things a lot simpler. So let's say we're gonna dictate the lowest price is reached 160. Okay, now so let's say I'm gonna aim to sell all the way to January next year. So I can choose, you know, to lay back, all right, sell what we have now, like almost 6 months to 7 months, almost 7 months options expiry on BRKB, right? And I'm going to choose 160 strike for example, say put options. Okay, and right now the market allows me to collect somewhere along the lines of say 750. Okay, right? So the market is willing to pay 750 for $160 put option. Okay, 750. Now, but what you will see is this: you could do, you could do what we call sell immediately, a 7 months option to expiry, or you could do this on what we call a week-to-week basis. Month-to-month basis. Okay, now, so if we do this month-to-month over here, right? So the nearest month will probably be this one, which is about 25 days. So we sell the 160 puts over here, you're looking at somewhere along the lines of 55 cents. Okay, 55 cents. Now, so if you do this, right, that means if you're capable of repeating 55 cents in premiums, right, over a span of, let's see, over a span of 200 days. 200 days is divided by 7. Oh, I think this will be better actually. 200 days divided by 25 days, right? That means you should be able to repeat this 8 times. Okay, all right, 8 times. That means 15 January expiry would mean you could repeat a 17 July trade 8 rounds. Okay, because the days tally would be around that part over there. Okay, so 160 puts, about 55 cents, so 8 times 0.55. Right, that means you're going to be able to get $4.40 if you're repeating this over and over again. Now, as you can see over here, the 160 puts over here for, like 7 months straight is actually paying you more. Right, it's actually paying you more. It's paying you like $7.50. Right, versus if you do this month by month over here, you're only going to make like $4.40. So now, why don't you tell me, right, which one presents a better deal, right, if you want to sell it right now? Okay, so numbers will actually dictate the play over here. Which one presents more value? All right, and what's your outlook on the stock? First, if you say, Terrence, I have a longer term outlook over here, then the next question is, right, which one is a better deal? All right, which one is a better deal over here? If you pick, let's go back. All right, if you pick the 17 July, it has the 25 days to expiry. Okay, but for the same deal, because we are looking at both the 160 put, for the same deal, you're only going to get paid 55 cents for this. 55 cents for every 25 days. Okay, all right, now we calculated earlier, you can repeat this same trade 8 times, right? And that will bring you to the same January expiry, right? So 55 cents times 8 times is only somewhere around $4, all right, 4 plus, right? But immediately, if you go out there right now and sell the 15 Jan, right, you realize that they're paying you almost $7 up front. So $7 is definitely going to look much better because you're going to be able to sit back, relax, let the stock do whatever it wants to, right? And you're getting a bigger payment up front. Yeah, okay, so in this relevance over here, this sounds like a much better deal. Okay, Kane, I hope that answers your question over here. All right, now, next one. Just another question. Is it better? Let me post this question out. All right, so just another question from Kane as well. Is it better to sell options on 100% of the portfolio, or is it better to sell options on 80% of the portfolio and buy options on the remaining 20%? Okay, now, so this question over here, it's up to your portfolio planning. Okay, now, what do I mean when I say up to your portfolio planning? Because everyone is a little bit different. Okay, think of this much like a property investor, right? Property investors are made out of two different kinds as well. We have the income investors, that means they buy properties for rent and then look at capital appreciation, of course, right? And then we have the other side of the spectrum, which we call the flippers, right? Now, but then we also have a little bit of both. That means, people who have 80% of their portfolio in good properties for rent and appreciation, and then the final 20% of their capital, they keep it for flipping opportunities. So what fits your bill? Right? Everybody's built a little bit different, so you have to understand what fits your bill over here. Because we have discussed some option buying strategies, they present great profiting opportunities. Like, if you believe, like what most people say right now, the round two of the sell-off may happen, it may come. So, if you believe in that sort of, directions over here, you would actually think about buying put options. Okay, it may not be cheap, but you may think that, oh, if I buy a put option right now, and when the market goes down like it did in March, I'll be making a killing. All right, but at the same time, all right, do understand this. Nobody can get to time the market, right? So if you're lucky, the market comes in your favor. But if it doesn't, it may mean that you may spend the entire of this 20% of your portfolio buying and buying options, waiting for the event to happen, but it just doesn't come, right? So by the time you have expensed the 20%, it may not happen. So you may end up losing the entire 20% as well. So first, you have to dictate what kind of investor you are, right? Are you more, to the conservative side of things, right? If you're more on the conservative side of things, then what kind of portfolio do you want to build around it? Okay, when you're selling options, are you selling options from a portfolio perspective, or are you selling options from a trading perspective? That means, in relevance to the stock that you're selling options on, is it a stock that is worthwhile to keep, right, in your own portfolio, or is it just a stock that you're trying to sell options as a trade to try and make some money off it? All right, so this brings about a bigger question when it comes to portfolio planning. Because any investment, if you don't bring portfolio planning into the picture, then it's just a trading psychology, right? And when you're doing a trading psychology, then obviously it's never good to have 100% of your entire investment portfolio in a trading strategy, right? Because trading strategy usually brings about higher risk amounts. So like, a lot of veterans or a lot of other mentors out there will also tell you, trading strategy usually forms about 20% of the capital. Right? If can 10% of the capital, at most 20% of the capital. Or they're either doing this on money that they've set aside and are willing to lose. Yeah, of course they don't want to lose it as well. And they may be very skilled such that they won't be losing this money, but they will still be playing what we call play money. All right, where do their safe money goes? You probably need to ask them to dig deeper, but it's probably going to be in some safer assets like stocks for the long term, or maybe properties for the long term, or maybe even businesses that they run. Yeah? Okay, now Kane, I hope I answered that question of you. Right, anyone else with any other questions? No? All right. Welcome, Kane. All right, welcome. Yeah, it's always up to portfolio. All right. Remember, investments is about each individual. Everyone is built different. That's why in our community over here, we give a basket of stocks over here, right? That's precisely the point, because in a basket we have up to about 100 to 200 stocks over there. Everybody is a little bit different. Some may like Coca-Cola, some may like Pepsi, but they are all in the basket. So pick your stocks over here. And once you pick your stocks, then go ahead, sell options in them because you are already comfortable. That's, the simplicity of being an impossible investor. First, we start off with the right stocks. The right stocks are different for everyone, right? So there's no standard protocol, right? But it's right because of our very simplified, fundamental matrix, which keeps things easy yet commonsensical, right? Once we achieve that, we go ahead, calculate our valuations for these stocks, and we start selling options around them. Okay, now let me pull this out. Let me go back to my PowerPoint slide. Okay. All right, great. Now, so thank you very much. If there's no further question, then this is all I have for all of you today in the topic of time value versus claim value with options trading. So I hope I bring another clarity and understanding to options trading to you as a whole. thank you for joining me on day 22 again. Tomorrow is going to bring about day 23. And we're going to discuss on this topic called options alienware. All right, now, so why do I use the term options alienware? Because tomorrow we're going to go into the topic of Greeks. All right, so Greek, option Greek. Okay, all right, now, so you may even hear it. Yes, option geek. Yeah, right now. So tomorrow we're going to geek out on options over here. Right, things like delta, things like gamma, things like vega. All right, what are they, Terence? How do they affect options? If I trade options, must I know them? Can I ignore them? All right, now, so tomorrow we're going to touch on these topics over here, and we're going to discuss all these things about the Greeks and how it affects option prices when you are trading them. Okay, so if you're interested to find out more about this, or you have always been seeking to clarify all the doubts that you have when it comes to this, join us. Stay tuned for tomorrow's session. Tomorrow is day 23. We're going to start at 9 p.m. live, right? Singapore GMT plus 8 time, right? Now, so if you've not joined our Telegram channel yet, okay, get updated on markets every single day, and also, impromptu live sessions that I'll be running, right? We'll be posting them more in the Telegram channel after this month of June. Okay, so make sure you scan the QR code and put yourself in our Telegram channel. Okay, alternatively, if you're new with us today, right, you may have missed out many days of many different option strategies we've covered. Head over to our website, impossibleinvestors.com, right? Opt yourself into Project Options Cashflow, all right, and get yourself started all over again. Meanwhile, thank you all for joining me again tonight, once again. All right, if you have not shared out the video, help us share out the videos so we can reach more people, okay, who are interested in investing, right? And have a lovely night tonight. There may be bargains in the market tonight for Impossible investors. All right, go out there, look for your stocks, see if they're good trades for them. Right, if they are, go ahead, create some cash flows for yourself. And for the others, I'll see you tomorrow at 9 p.m. Okay, thank you very much. Bye-bye. This is Impossible Terence Tan signing off. Bye-bye. Good night, everyone. All right, welcome, Ruben. All right, bye, Sai. All right, welcome, FT. All right, welcome, Josephine. Welcome, Maureen. Welcome, Sunny. All right, welcome, James. All right, welcome, Christine. Bye-bye, everyone. Bye, Anthony.